What's going on, guys? Welcome back to another video with the Options Retirement Academy. In today's video, what I want to cover is the wheel strategy and why I would be using this strategy leading up into earnings on SoFi, which is on January 30th. Now, a lot of people think that they have to do some risky strategies for earnings because earnings is going to be a really big deal. But the truth of the matter is the wheel strategy is a really good strategy for collecting income without really having to take on that much risk. So I want to go over a quick tutorial and kind of break down step by step what I would be looking for with SoFi. So let's go into SoFi here. Now, SoFi is a great company in general. You guys know that I love SoFi. I made several videos on SoFi, specifically the wheel strategy. But SoFi as a company has really great marketing. They're able to acquire customers for a very cheap cost. And I think this earnings quarter is going to be absolutely amazing. We're going to see something interesting, which is a $33 million fee that they have collected. It's a one-time only kind of fee for termination that they had with one of their clients, Chime Bank, which is also a competitor, but they have a one-time fee for a termination of an agreement. Okay, so that's going to be interesting. I think SoFi is going to see really strong earnings as well. Keep in mind that they have over 1 million new members coming in for Q4. So again, big stuff. But, it's not always easy to predict what's going to happen with the stock itself, right? My base case is if we look at the technical analysis on SoFi in the last 6 months, the stock has been over $30 per share several times for not the longest periods of time, but right now it's sitting at a really good support level, right? So $25 here, $25, and now we're at $25. So this is actually the perfect time to run a wheel strategy because what I'm seeing on a technical basis is that we're at support. So I would actually be comfortable putting in a heavier amount of monies in the wheel strategy. Let me show you. So I'm going to go to trade SoFi options. Okay, I already have shares of SoFi, but when the market opens up, this is actually what I'm going to be opening. So I'm going to go so January 30 is the earnings day. So February 6th would be the next available expiry that captures earnings. So that's pretty much accomplishes our goal of making an earnings bet. Now, what's interesting is with the wheel strategy, it's all about income. So we're not really making a hardcore bet. We're not saying, hey, this has to happen, right? That's buying options. When you're buying options, you're like, hey, for example, if you buy a 27 call option, you're like, hey, it has to be above 27 and I have to make enough money to break even beyond the premium that I pay for this. So this has to happen at this date for sure. It's strict, right? Whereas with the wheel strategy, when you're selling a put option, it's pretty much the opposite. It's like, hey, this has to not happen, right? So if I sell a $26 put option, which is pretty aggressive, it's a very high delta, right? So here it's a high delta 50, but this is okay. Leading up into earnings, if I'm bullish on the stock, then I'm okay going much closer when I'm, beginning the wheel strategy and selling a put option, right? So here, $26 strike price, 50 delta. The premium here is $1.60, which is pretty insane. So it's like 4, 5, 6%. It's over 6% in terms of premium collected, right? Now, whether this trade works out or not really depends on several factors. And what it depends on is, will SoFi go up? If SoFi goes down, the premium that you collect is still yours to keep, but you will, get assigned on SoFi if it's below 26, which is actually a good thing, right? Like literally it's a good thing. Like the reason why I make a lot of wheel strategy videos is because it is very conducive to a retirement portfolio, right? If your goal is retirement, which is what I teach on this channel, small channel here that I started with several other option coaches where we have a program that we go live basically every single day and we go over strategy or option trading techniques, and it's me and 2 other coaches at the moment. Well, it's pretty easy to use a strategy to retire. It is really easy because when you're selling options, you don't have a high level of risk. In fact, the worst thing that can happen is you get assigned on a stock, but if you want to own that stock, right, for like SoFi, why wouldn't you want to own it? You're watching this video because you probably heard of SoFi. You might already have SoFi in your portfolio. You see lots of other videos on YouTube about SoFi. So it's pretty clear that this company has been on a really good trajectory, very strong momentum. The market cap's at $32 billion, and I've been covering this company for years now. Like I was covering it when it was, $8 billion or so like that. Like $7-8 billion is when I started really gaining interest in SoFi. So I've been really early on this play, and it's multiplied, but I still see strong momentum. Specifically because marketing is good, lifetime value is good, they continue to have more products, and they're just making a lot more money. So this is a really strong play on fintech, specifically the adaptation of like new fintech companies, right? We have lots of older banks. I used to work at Goldman Sachs, very like archaic old technology where SoFi is really innovating. So, without having to go into too much detail, strong company, and running the wheel strategy, in my opinion, is just really a no-brainer, because what happens is if you sell put options, you collect premium, you collect income. Now, either two things happen. Either the stock goes up and the premium's yours, and that's cool. And here we already talked about the premium collected is a really high return, especially in the 15-day period, or it goes down and now you have a break-even cost of $24.34. So that means that even if you get assigned, SoFi is at 25, you still made money because your average cost is $24.34 because you collected premium, you collected income. So that actually lowers your average cost. That's what's nice about the wheel strategy, is that when you're selling options, it's directly influencing your average cost. You're lowering your average cost, right? In a quick, 2 sentences on the wheel, it's essentially selling puts to acquire the stock. Once you're in the stock, you go into the next step, which is selling covered calls and generating further income. That's pretty much the wheel. Really simple, straightforward strategy. It consists of selling puts and covered calls. The first step is selling puts. The second step is covered calls. And then if you get assigned, then you're out. You don't have that stock anymore, and that's fine. You've essentially run the full cycle wheel strategy from start to finish, right? From A to Z, which is great. So what I'm looking at for earnings for SoFi is just like literally, I know I've been talking for 6 minutes. I'm sorry if you feel like I haven't gotten to the point. Here's the point. You sell puts at 26. If you get assigned, you hold SoFi stock and you sell 1 to 2 month covered calls at a 30 delta. So essentially, if you get assigned, then you just go ahead and sell something that's like 30 delta. So what that would be is you would just switch over to sell call, and then you would sell something like 29. No, you would go to 28. Let's go to 28. Perfect, 30 delta. So then you would just start selling 28 covered calls, for example, right? You just sell 28 covered calls and that's it. Like now you're collecting, albeit not huge money, right? It's not massive amounts of money, but this is like a couple percent, which adds up. And if you do it on a monthly basis, keep in mind, you have upside, plus you have income coming in. I mean, it really doesn't get better than that. And this is not a very expensive strategy to run. This is not the capital that you would need on this, selling a put option is literally about $2,600. But because you collect $160 of premium, Robinhood here is saying you need $24.40, okay? It's saying max loss. Don't worry about that. In the wheel strategy, the max loss does not apply. It's literally not applicable because the max loss is in theory correct if the stock goes to zero. But I don't know about you. If you're a complete beginner, maybe you think that's possible, but it's literally practically impossible because SoFi has cash, it has IP, intellectual property, it has employees, it has a lot of stuff. I'm sure you understand it's ridiculous for the stock to go down to zero, but in theory, it could. I mean, they could go bankrupt in theory, but you see what I'm saying? So the max loss does not represent what is really accurate. Like that's just not really possible, right? So don't worry about the max loss. Just kind of replace max loss with what I would consider capital required. The capital required would be $2,400, and then you would collect $160. So, this might not seem like a lot of money, but it really adds up if you're consistently running the wheel strategy, especially full circle. Because again, on the covered call portion of the wheel strategy, you collect upside on the stock, right? When you sell puts, you don't collect upside on the stock. You're like, hey, I'm getting paid this amount of money, and that's it. You're waiting now until expiration. In most cases, you don't have to manage the position at all. You literally do not have to manage this position. There's nothing to manage. You just wait. That just literally wait. Chill out. You guys that are looking to manage positions and get in and get out. I don't know what kind of YouTube channels you're watching. I don't know if you're watching the wrong day trading channels or the promises out there. Listen, in the Options Retirement Academy, I have the most simple program. I've been doing this for over a decade, right? And my team has also 7-figure coaches. The other 2 coaches that work with me are 7-figure coaches. It's really simple. You sell a put and you just chill and you wait. And if you get assigned, good. You just go into step 2 of the wheel strategy and you start selling covered calls. And then you wait again. You do not need to manage positions early. Like literally, if you manage a position early and you start closing it early, that's the wrong thing because now you're just working extra to get worse results. Like, do you want to work more to make less? No, right? So just sell for example, I would look at selling the 26 covered call. I would sell the 26 put, and then once assigned, then at that point, I will sell $28 covered call. But most likely, like literally 7 out of 10 times, right? No, actually 5 out of 10 times, 50-50. Delta is, what delta means is the chance that the option will expire in the money. So literally this is 50-50, but it's really not 50-50 because stocks just tend to go up. SoFi has a long track record of beating earnings and going up. So although delta is 50-50, it's not really 50-50. I mean, I guess technically it is, but I just wanted to show you their earnings. You can see here, they've beat 1, 2, 3, 4, 5, and they matched those earnings. So literally the delta is 50%, but 5 out of 6 times they have beat earnings and 6 out of 6 times they have not failed. They have not delivered bad earnings. So 5 out of 6 times it's a beat, and 6 out of 6 times it has delivered at least good enough results. So like, do you kind of see what I'm trying to do here? Like, I'm trying to put you in the biggest winning position. This is what I do in the Option Retirement Academy. I just pick the simplest, most obvious plays, and then just super simple, just wait. And most of the time this stuff works. So yeah, going into earnings on January 30th, I'd be running the wheel. I'd be actually comfortable with putting in a significant amount of money into the wheel. Like, my position on SoFi right now is actually fairly small, although it's like 132K worth of market value. And I'm up 15K and my average cost is $23 per share. I'm really comfortable like purchasing a few thousand more shares. So I do have a 28 put, which is actually in the money. I did this position a little bit ago because, you know, I make trades in Discord and stuff. But once the market opens up, I'm just going to sell more puts exactly as I'm talking about here, 26. And I'm going to go pretty heavy. I don't mind. I don't mind at all. I think we, you know, on a technical basis, 25 is really strong support. So I'm going to go a little bit riskier. I'm going to go for 26. Nothing wrong with that. 25 is already a strong support. So 26 would be comfortable for me. So I'm going to be running the wheel strategy with two strikes, 26 on the sell puts and 28 on the covered calls. You can actually see 28 also makes sense because I'm selling 28 puts. One last thing that I want to mention is selling a put and a covered call are very similar, right? They have very similar capital requirements and very similar returns. So these are my two favorite strategies. But for the wheel strategy, the first step is selling puts. And if you want to actually master selling puts, I have a really awesome free video here on YouTube. I want you to check out right here. It's the most important video on selling put options. Your time will be very well invested if you understand the selling put portion, strike selection, expiry, and just if you master selling puts, I'm telling you, I promise this video is going to be well worth it because then you can really start to master the wheel strategy. So check it out right here, and I will catch you in the next one.